And the tennis shoes, right?
Yeah.
And Jay, you'll quickly find out that it's Kelsey. Rick doesn't know anything about the camera. I don't know anything about the camera. She sends us links, and we just hand out the credit card, and then we give it to our account. Right? That's how it works.
So you guys are the talent, right? And then, so Kelsey's the person I need to talk to afterwards. That's what you're saying.
That is it.
That's awesome, guys. Well, look, we're recording. I want to turn it over to you, and let's get started, okay? Everybody in the chat, you have questions, please let us know. Drop them in before you forget about them. And please try to make it to where you're dropping to all panelists and attendees, because somebody else may have the same question as you, okay? All right.
Awesome.
Rick, Paul, the floor is yours, sir. Sirs.
All right, so quick disclaimer. Rick, have we ever done this before, the two of us?
No, we actually have not.
And we thought about doing some dry runs, but then we're like, no, it's probably going to be the best of first go around. So big thank you to you, Jay. It's awesome of you to reach out. A big part of our business, and what we'll get into also with real estate investors, as you know, it's market, right? 80% of your time, spend it on marketing. The other 20% of your time, spend it on all the other stuff. So it's speaking opportunities like this to where we get to present to other like-minded investors it's awesome. So thank you very much. We hope to deliver on the topic that you asked us to present on. I had a lot of fun putting it together.
No, definitely.
Rick and I were text messaging early mornings, late nights, so a lot of fun with it. Started with the slide here. So how do we get financed after quitting your 9 to 5? Another topic we could call this is how to get financed after
Getting laid off from your 9 to 5.
getting furloughed from your 9 to 5, all of it, right? So when we're getting financed here, there we go. Perfect. All right, it's working over. So the intention of today's presentation is to go over how do we get approved for a loan once we have been laid off, once we have been furloughed, or once we just said, hey, I quit, I'm going out on my own, I'm becoming a full-time real estate investor or a full-time restaurant owner, whatever it might be, right? So the intention today is to give you tips, tricks, and tools to get you approved. Now, I don't think I've ever done a presentation with people from Canada watching.
I have not.
Florida. We tend to keep it here very local in God's country of Texas. With that being said, all these rules, they apply for all over America, right?
Yep.
So
The vast majority are national rules.
so it works out. So whether you're in Florida, Texas, or anywhere else, these apply to you. So if we were together, I would say, hey, by virtual show of hands here, who believes this slide to be true? Rick, do you believe this slide to be true?
No, sir.
Why not, Rick?
Knowledge is, you need more than knowledge.
So I don't know how many of you are a fan of this cartoon right here. When I was a kid, man, I couldn't get enough of this show. Like just going after Cobra and just crushing those dudes. And it was just awesome. Like I loved G.I. Joe. And then
I woke up early before school to watch it.
This guy, private schools. And so G.I. Joe at the end, they always, what age were you when you figured out what they meant by this?
Honestly, probably 40.
I was like easily my late 20s, right? Like what are they talking about? What are they talking about? And then I got it. Like knowing is half the battle. If you don't apply what you've learned, forget about it. It's just half the battle. So this is our invitation to you today. I promise we will deliver. You will get some good nuggets here, and it's up to you to apply the knowledge. Just knowing it, it's not going to make a difference to your business. So I am having fun with what's up with my clicker, Rick. There we go. Perfect. There we go. Can we just do it here? Is this easier? Sorry, guys. Yeah, this is easier right here. All right. So how do we get financed without W-2 income? What's the first way, Rick?
Tax returns.
Well, I don't have W-2. How do I have tax returns?
Well, you should have the income you're reporting to your Schedule C in your tax returns if you're early into your entrepreneur career.
Can capital gains, if I'm a full-time flipper and I have capital gains income, can that be used as income?
Technically, yes, but it will take some creative underwriting.
It's the back end stuff that gets in the way with inventory and the qualifications of this. But how many business owners do we run into who had a W-2 at some point and then they end up saying goodbye to it, but they still make income. They still have income that shows on tax returns. You've done multiple loans for clients that own multiple properties, and the bottom line shows profits. So they're able to get financing even though they don't have the W-2.
Exactly. Yeah. We go off your net profit. So if you've got income coming in from flipping, if you got income coming in from rentals, we're able to look at all that and figure out ways to get the income to count for an underwriting.
And so this is, we wanted to start off with this because it's often overlooked. It's, well, I quit my W-2. Okay, well, for the first year or 2 years, it is going to be a little tough for you because like any entrepreneur, any business that gets off the ground, banks, lenders are going to want to see a 2-year history. But when you quit, you know, Rick and I, we quit our jobs, what, about 3 years ago? In March, it'll be 3 years. And now we're out, we have 3 years. So our business tax returns show profit. So in your first early years, it may not show profit, but don't forget that as the years go on, your profit increases. So tax returns, number one way without W-2. Bank statements. Talk to us about this.
We've got a couple great bank statement programs. They'll go off of personal or business bank statements. From as few as I believe like 6 months of bank statements all the way up to 12. And it's really available for people who still aren't showing profit on their tax returns, but have a high gross income that comes into their bank account.
It's cash flow, right? Like we want to see money coming in. Underwriters, have I ever told you the joke? What's the difference between an underwriter and a terrorist?
No.
You can negotiate with the terrorist. Yeah, negotiate with underwriters. Like, forget about it. But knowing their guidelines in advance, right, it gives you an upper hand. So with bank statements, most of lenders that we'll get into more later on in this presentation, they're going to give you an option, either personal or business, as Rick mentioned. With personal, typically take a look at a 12-month period. Business is typically a 24-month period. And what's being looked at here are the deposits that are coming in. What's the cash flow that you're receiving? On personal, 100% of the deposits. On business, 50% of the deposits is the typical rule of thumb with it. So if you are someone, again, don't have the pretty W-2, but have cash flow coming into your bank, you can use your bank statements as income. All right, what's DSCR is what it's known to in our industry. Explain this to us.
So we got debt service coverage ratio. What this does is this takes the income that the property's bringing in and it compares it to its debt service. What's included in its debt service? It's interest, any kind of insurance payments, taxes, lease payments, all of that goes into the debt service.
Yeah, so it's what is your payment? How much are you making? Divided, and what's that formula? I tell you, when you are making a 25% plus profit, looks really, really good. So what is 25% profit? Your total payment, principal, interest, taxes, insurance is $2,000.
Mm-hmm.
Now you're renting it out for $2,500, right? That $500 above the $2,000 is that 25%. So if you're making 25% or more, you're really, really great. If you're making less than that, doesn't mean you don't have loan options. Just means your loan options, you end up paying a little more is all. All right, fourth way, liquid assets. When you have gold, you can get cash, huh?
Very true, very true.
So what, when we put this together, we talked, I couldn't find a heavy liquid assets. There's a band actually out there, heavy liquid asset. When I was Googling the images, I was like, that won't go over well.
No, I don't think that's the heavy liquid.
So what do we mean by this right here?
Basically what it is it's a compensating factor, but it has the ability to be the entire factor. There's several different products. One of them is actually with the conventional, divide your liquid assets by 360. That gets you a monthly income, and then you just have to qualify from that. Other ways are,
what the heck did you just say? I didn't even get that.
You have to.
I did get it. I just know they didn't.
So you take your total amount of your liquid assets, you divide that number by 360.
Say it's a million bucks.
Million bucks divided by 360.
Why 360?
For the days in the year. So, I mean,
loan
for the loan payments.
First time we've done this. This is good. No dry run. We told you guys. What if I do a 15-year mortgage?
Then we divide by 180.
Okay.
So what you guys are cracking me up. No, I love the camaraderie that you two have together. I'm sitting over here writing notes as fast as I can, and you guys are cracking me up. I was going to ask about the 360. What does that mean? Because I was like Paul. I was like, this is 360. Anyway.
So it caught me off guard. So
thank you for clarifying that.
Good jump in. So yeah, it's a long term, right? So if we're doing a 30-year loan term, 30 years times 12 months gives you 360. If you're doing a 15-year loan term, 15 years times 12 months is 180. So you take the amount of liquid available assets you have divided by the loan term, and that can give you monthly income. So it works out when debt to income ratios, debt to income, the ratio in mortgage lending needs to be less than 50%, the short version of that. So whenever you're a little tight or need some more, need a little more income, this really works. This also works for those that are just heavy assets, right? You've got a few $100,000 in the bank. You've got a few $100,000 in your IRA account, and you're coming and saying, look, I want to borrow 200 grand. Well, if you've got 300, come to me, I'll lend you 200 any day. We love, as banks and lenders, lending money to people that really don't need to borrow it. So it's when you have a lot of assets, that's you really flexing your muscle and saying, hey, you sure you don't want to lend to me? Because if you don't, I'm just going to go down the street. I'm going to find bank B. They'll lend to me. And when they do, you know what I'm going to do with my pile of cash?
I'm going to go buy more properties.
I'm going to take it over to bank B and buy more properties. So if you've got money in the bank, that works also for long-term financing. All right. So we've done 4. We promised 5 reasons, right? Mm-hmm. So we're on number 5 right here.
Yes.
Why are you smiling? Okay. Not what you're thinking, sugar mama, sugar daddy, or sugar babies. Instead, think strategic partner. Somebody who has the pretty W-2. Somebody who has similar aspirations to you do as far as owning rental properties. Blink Lending started because I went to my mother and aunt and I said, pretty please, I have this awesome idea. I promise we're going to knock it out of the park. Pretty please, I need your money. And thank gosh they believed. And there's tons of clients that we have who don't necessarily fit the box of conventional lending or don't fit the box of non-conventional lending, but going in, mom, dad,
uncle,
just your inner circle, right? Of strategic partnerships can get you the financing. Great way of it is I just left my W-2. I'm going to go out with all this energy and I'm going to find lots of properties. I'm going to find great deals and I'm going to find some strategic partners that get me rolling along for the first 1, 2, 3 years. And then once I'm there, now I can still keep those strategic partnerships and I can also branch off on my own and start doing my own things because now I've gotten history and all that, right?
Nope. Yeah, definitely.
Where can you find strategic partners?
Your inner circle. If you're newly entrepreneur, you probably have a little bit more, not necessarily free time, but time to go investigate properties. When you're in your W-2 income, you come home, you've got family, kids, whatever, social obligations, and you may not be able to go do all the research on the properties. You may not be able to go visit all the properties. Be there to get the quotes for the rehabs. Be there to do all that fun stuff.
Look, with the strategic partnerships and forming them. Go ahead, Jay.
So I love this idea of having a strategic partnership. A matter of fact, I talked to a guy this morning where we're actually more than likely going to do this strategy. My question as a bank, because strategic partnerships can be divided up. There is no silver bullet, right? I've had people all the time saying, well, I Googled partnership and how the partnership agreements work and what's the most ideal way. There is none, right? It's whatever you and your partner come up with. But as a lending institution, do you guys care how that partnership is divided up?
So the answer is always going to be, it depends, right?
Depends.
And the reason that's the answer is because it's really what bucket of financing are we going to get our money from? We've got, as investors, we have 4 available loan options. And based on which loan option we want to go for, they're going to have different rules. So conventional financing is going to have different rules than non-conventional financing, or than commercial financing will have, or private lending financing will have. The all-encompassing of it is it starts at the beginning, right? And I love what Rick said about it being, it's really right under your nose. He said your inner circle. Notice he didn't say go to networking events. He didn't start with that. He didn't say, start going on social media and finding these places, because so often it's right under your nose of where the best partners are. And then often the partner will show the strategy that's best for it. I can tell you the easiest place for financing with partnerships are commercial banks, right? Local banks. because there it's common sense lending there. It's, well, who are you as a person? Do you pass the smell test? Does your profile pass the smell test from a credit, an income, a cash flow standpoint? And where's the property located, right? For the gentleman that's in Vancouver, where if you're looking to buy a property in Texas, well, you're not going to want to use a local community bank out of Tennessee, right? It just doesn't work that way. So you're going to want to, where am I getting it? So Jay, if I could, what I'd love to do is pause that question there, get to the 4 different loan options, and then kind of chime in how partnerships work throughout that. Is that fair?
Perfect. Absolutely. Yep.
Love it. Right under your nose. All right, 4 available loan options. Where's my, do you guys see how that's moving there? I did that on purpose, Jay, and I did that on purpose because as investors, just because we don't have a W-2, we got to keep moving, right? Like our investments got to keep moving. So this is us continuing to. I thought it was hilarious.
I love it.
So first,
I love it.
First option we have as investors, guys, don't forget conventional loans. Conventional loans. They're not as difficult. They're a bit challenging, but they're not as difficult. So what are conventional loans? When you start hearing Fannie and Freddie, Fannie Mac, Freddie Mae, these are your interest rates, your really good loans. What can you expect when it comes to conventional financing? Well, you're going to get up to 80% loan to value as an investor. We could have put 85% loan to value, right?
Yeah.
Why didn't we?
Has mortgage insurance.
And the rates jacked up.
The rates are higher. The cost is significantly higher. And so it becomes, you're only saving about 1 or 2% of actual money, and you're giving up, but you're cutting your cash flow. So
it's cutting cash flow, it's cut your rates higher, and then also your loan balance is starting out higher. So the amount of interest that you're paying to get your loan back down, we're just not going to let you do it. If you truly believe in the 85%, awesome. There's plenty of lenders out there that do it. We just choose not to. It's not smart. Your rates, what can you expect today with conventional financing? Why do we put 3.75-ish with this plus minus thing there? Why didn't we just give them a pretty rate?
Because rates change daily, actually hourly. So you can't really quote a single rate today and expect it to be available tomorrow. Now, the market is holding. So, typically rates are there for a few days, but when they start to move, it gets real, it can get real exciting.
I see, but you're telling me, or I'm telling you, that rates are 3.75-ish. I see on TV, I see on the radio. I don't see it on the radio. I hear it on the radio. I see it online. Rates are like in the 2s. Why 3.75 here and not rates in the 2s?
Well, the rates in the 2s are going to be under your perfect situation, typically purchase primary residence.
Did you guys catch that right there? Primary residence. We're talking investment properties here. So the rates that you're going to get are investment property specific. Everything hits the fan. The world's coming to an end. I've got the house I live in. I've got a rental property. Where am I going to stop making the mortgage payment first?
On the rental property, and the banks know it.
I mean, it's just common sense, right? Mama's got to have a place to live. The girl's got to have a place to live. Rick's got to come over. We've got to have some beers. So we need the homestead, right? The investment properties get chucked out. Go back to 2018 or 2008 rather. Wow. 2008, it's there. So rates 3.5, 3.75-ish. Now, as your loan to value drops, so does your rate.
Yes.
Right. Lower risk, lower terms.
Yes.
In 2008, it wasn't these adjustable rate mortgages and all that. It had a little thing to do with it, in my opinion. But the biggest with all this 100% financing stuff, I could buy a house with no skin in the game. Yeah. Now my payment goes up. Bye. 30, our loan terms, 8 to 30 years, huh? Talked about these fixed and adjustable. What is ARMs?
So ARMs typically are going to come out with, fixed is what it is. Fixed is 30 years fixed, 20-year fixed, 15-year fixed, and they even have creative terms so that you can customize it to just about any year amount in between. With ARMs, they're going to have a fixed period, and then they're going to start adjusting, typically based off of prime, usually plus a certain type of spread.
Oh, you keep talking like that, Jay's going to have another question. We got 37 minutes to wrap this up.
Typically adjusted off of Wall Street Journal prime rate.
So ARM, it's acronym, adjustable rate mortgages, fixed rate mortgages, adjustable rate mortgages. You have options,
yes,
right? Others, not as much. Origination, you can pay origination, you can not have origination. I'll let you jump into that when I go multiple cost adjustments. And underwriting costs, what's that? What's an underwriting cost?
All the banks are going to charge, all the underwriting teams are going to charge a certain fee to get the loan completed. It's just to help cover the cost of all the stuff that we have to do up front, ordering different invoices.
The underwriters just putting their hand in your cookie jar. It's a fee, just charging you a fee. They have salaries, they have to be paid. Let's call it what it is.
It's just a fee.
It's a fee. It's a fee. Now, can it be waived?
Yes, it can.
Yeah. Some people, you can say, hey, I don't want to pay this fee. I'm doing multiple loans with you. Waive this fee. There's also processing fees and all this other stuff. Here's the takeaway. You can choose to pay it. You can choose not to pay it. And if you want the inside scoop on how to get it waived, call us. We'll give it to you. Then call your favorite lender. Do the loan with them. No big deal. Multiple cost adjustments. All right, cost. We've got it bolded. We've got it capitalized. We've got it underlined. What the heck does a cost adjustment mean?
So a cost adjustment is a way that conventional loans make rates available to everybody. So somebody with really great credit may get a 3.75 with very minimal cost. Somebody with less than great credit can also have 3.75, but it's going to cost them more. So the cost adjustments are going to go for credit score, property type, loan to value. So how much equity is in the property.
Why is credit score important to a bank in giving loan terms?
The credit score is important because it's how you honor your word in the past. And if you're not paying people in the past, you're not going to pay people in the future until at least you show the credit bureaus that you are paying people.
Yeah, it's like, you're not going to start paying until you start paying, right? And well, if you haven't shown a history of paying and your credit score is low, well, we got to charge a higher interest rate to offset the risk that you present as someone that doesn't pay
their
bills, right?
Yeah.
What I love saying about credit is your credit score is your numerical representation of your ability to do what you said you're going to do. Now, please don't hear us as being, uncompassionate. Things in life happen, right?
Yes.
Divorces can crush credit. Businesses right now with what's going on are taking a hit and their credits being impacted. So there are life situations that comes up. We can see that on a credit report, right? Because what it is it has this perfect line chart here, and it's like payment history, and all these accounts. And then all of a sudden you just see this one big blip, like here in this 3 to 6 month period. And you're like, hey, Rick. And before you're like, everything was good. What happened right here? And then you get the story and you're like, okay, I can get that. Now, when you're looking at it, you just see bip at 18, at 25, at 36. And now they're 42 years old and they're going to flip a house and they're going to, whoa, wait a minute. You need some practice at doing what you said you're going to do. Let's practice with your light bill a little bit. Then come over here.
Exactly.
So multiple cost adjustment. This is Fannie and Freddie Mac's way of offsetting the risk, right? What's your credit score? Loan to value. The higher the loan to value, the higher the risk. And when the higher the risk, again, the higher the terms. I mentioned about 2008. There was no 20%. People were putting 20% down and 30% down. As investors, we could do 100% financing with a 680 credit score, stated income, stated assets. There's this program called NINA, no income, no assets, meaning you didn't have to have income. You didn't have to have assets, 100% financing. That's what happened, right?
Yeah.
So the cost adjustments, and then again, you mentioned them on multi-units. We get into cost adjustments on the non-QM loans, and they kind of lay on that. So we'll pause this here. Now, Jay asked, how are partnerships looked at? Well, with conventional financing, it's both borrowers. So if Rick is a borrower, we're both partners, and we both apply together, we're both signing on the loan. Now, if Rick and I have a joint entity together, Fannie Mae and Freddie Mac will not let you close initially in the name of an entity. Initially, that's a little trick there, but they won't let you close initially in the name of an entity. So our partnership in the entity doesn't come into play. Both of our personal credits, personal income, personal assets come into play. Now, if I got Rick, because he's a strategic partner, I'm the one that goes out, hunts the houses, and he's the one that's back there cutting them up and throwing them into the freezer for food down the road. That was a good metaphor on the wing, huh? Yeah, dap that up, buddy. So we're there. That works, right? I don't need to be on the conventional loan because all my debts, if I don't have income, that is, because my car payment, my credit cards, my student loans, this is now going to show up on and hinder Rick's ability. So Jay, for conventional financing, separate it. We also want to separate it with spouses. So if you're married, don't put the loan in both spouses' names. You want to keep them separate because that way, individually, their debt to income ratio, what are their debts to the amount of income they make, And what is that ratio? Remember, we want less than 50%. Excuse me. Talking too much.
So yeah, we want our debt to income to be less than 50%. Ideally, around 43% is where the kind of automatic number is. And in case you need any compensating factors.
So then you want to keep it separate, Jake, is for unconventional financing. Now, the question that I get asked is, can I put it back into an entity? The answer is yes. Typically, you want to wait 3 months and you can put it back in the entity, depending on if it's a Fannie Mae or Freddie Mac loan. So one says, yes, you can do it. The other says, no, you can't do it. But typically what will happen is we close and then later we go, hey, title company, can we change it over to the name of the entity and then transfer it to the name of the entity, keep making the payment, everything's smooth along sailing. But always review your loan documents. All right, let's move on. Non-QM. So conventional financing, we could call it QM, right? What does QM stand for?
Qualified mortgage.
Qualified mortgage. This came out when that Fred Dobbs.
Right after, in like 2010 is when it originated after the crash in 07, 08.
Dodd-Frank.
Chris Dodd was getting sweetheart loans from Countrywide. And they said, no, you can't do that. Everybody's got to be treated equal. And so that's when all this got created as qualified mortgages and non-qualified mortgages and stuff like that.
So when you hear so a great way when you're looking for a lender, if you're someone who's W-2 got cut off about 6 months ago, a year ago, somewhere in that range, and you're wanting to Google mortgage companies, lenders, just put in non-QM mortgage company near me, pop it up, start calling them. So moving on, Jay, you got a question for us?
No, I never understood what non-QM was, and that I didn't know Dodd-Frank was behind all that and getting those sweetheart loans. I've got a guy on my mastermind who uses non-QM, even though he's full W-2. He now has 10 rental properties. They're all on non-QM loans, and he introduced me to the concept. And to this day, I still didn't know the connection. So thank you for clearing that up. On the non-QM, are they underwrote very similar to QM, or is it completely different?
It's different, but the same.
Yeah. Okay.
Same, but different.
You guys looked at each other and smiled. There's got to be some sort of a backstory there, but
well, let's talk. I think the best way to explain is talk about the differences, right?
Yeah.
So with the QM loans, it's personal income that's being reviewed. So you're looking at personal tax returns. So now it goes back to this depends thing that we talk about. If you're someone who has 4 properties, and we're going through personal income, the conventional underwriting is going to look at your tax returns. If you've got personal, obviously your personal, they're going to look at, if you have business, they're going to look at your business. If you own 1 property or if you own 4, they're going to look at all properties together, right? Give me mortgage statements for all 4 properties, insurance, lease agreements for all of it. Now you do a non-QM loan and it's kind of marketed as an easier loan and that you don't need income to qualify for it. Personal income, but are you showing tax returns? Of course you're showing tax returns because, well, if you owe the government money, they can come in and take the house. So no lender wants to lend you money if you owe the government money. So we're going to look at tax returns. The excessive losses are on there. Well, now the underwriter is going to dive a little deeper. If you own 4 properties, well, all of those properties are going to be taken into account. So it's the same documentation. With the back and forth you saw, there's conventional financing to us is much easier actually than non-QM financing. And a big part of that, Jay, has to do with the people that we're working with on the other side. Your friend, the non-QM buddy you're talking about, he's graduated, right? He got his 10 conventional loans and now he wants to keep buying. Fannie Mae, Freddie Mac aren't lending to him anymore. He's capped out. Right. So he's I'm going to get these non-QM loans. He probably works with the same bank or the same lender that has his entire portfolio, so he's not constantly having to turn it in. But the person that works at a conventional underwriting department versus the person that works at a non-QM underwriting department, no disrespect to our government employees out there, but it's like private and government employee almost. Gotcha. Wow, this is recorded. I said that.
That's all right. Hey, we lost your video. I have a black square. I don't know if
Kelsey.
Let's continue
you
on.
Lost video. Do I need to hit a button?
Oh,
you
there
go.
it is.
You're back.
With that.
I'm tired.
And then I hit it.
It went to sleep.
Okay, perfect. So there I am.
There we go.
But it literally just, okay, I'm back. Perfect.
There you go.
All right, we're learning.
For next topic.
So Jay, after the non-QM loans, right? So it's conventional lending, then it's non-conventional lending, the non-QM. So non-QM loans, as far as partnerships go, that's when Rick and I, when we have the entity, we can go on the loan together with our joint entity.
Mm-hmm.
Here's where it gets messy. What if I have another entity? Well, I have to show that other entity and those other properties in there. And if Rick has multiple entities, he needs to show that. That's where it just gets, well, it's like a conventional loan all over again. You're just not going on the bottom income line there. So with non-QM loans, that's option 2. And now option 3 is commercial loans. Commercial loans, here you want to think of local, state banks that aren't publicly traded on Wall Street.
Yes.
Good old boy.
The closer to the house, the better.
So often we have investors that as they're buying properties in different areas, they just put in local bank zip code and they just call and say, hey, my name's Paul. I'm an investor. I'm looking at a property that's around the corner. Here are the numbers. I'd like to speak with your commercial loan officer. Commercial loan officer gets on the phone and then you go over the transaction with them. This is where Rick taught me this a few years ago. This can get very frustrating as an investor. I can call Bancorp South and I can get Jerry on the phone.
Yes.
And I can say, Jerry, this is what I've got. And Jerry can tell me, yes, it can be done, or no, it can be done, can't.
Yeah.
Maybe he's right, maybe he's wrong. But for whatever reason, I don't like what Jerry's telling me. And I'm like, Bancorp South does not do these loans. And I've just completely poo-pooed all over Bancorp South. When if I would have called in, instead of getting Jerry on the phone, I get Cindy on the phone.
Yeah.
Cindy gets it done, doesn't she?
Cindy has a lot more pull. So the person you talk with at your community bank, your local bank, does have a big influence on just how the deal gets done. And typically you want somebody who says yes a lot in that initial conversation. Go ahead, Jay.
Yeah. So I'm glad you guys said this, because I am of the impression that local banks, you hear about this all the time, go to a local bank that's got 4 or 5 branches in your town. I'm convinced they don't exist. Because when I've been on this practice here for a couple of months now, and there's a trending answer that I hear when I talk about, hey, I present myself, hey, here's my buyer profile. I'm looking to add it to my portfolio. And they all 3 of them now that I've talked to had this response. I feel like they all went to the same conference or got the same, webinar or whatever, because they said, well, we're not taking on people who are just going to buy investment properties. You have to bring your entire banking portfolio over to us for us to even consider what you're doing. And I'm like, and you're not willing to tell me what kind of rates or anything like that I'm going to get before I do this. And they're like, no. Okay. And this is like the very first conversation. And then matter of fact, I'll mention Ed from one of the local banks here. I mean, honestly, they're like maybe 30 minutes from my house. He talked me out of wanting to have a conversation with anybody else in that bank. And, on their website, they boast about how they work with investors and how they work with businesses and all this. And I was like, all right, Ed, I get it. You need a day off. He literally told me I have not had a day off since COVID happened. I've got this stack of paperwork from PPP on my desk. And I'm like, man, I appreciate your sob story. I do not care, man. So anyway, tell me have I just not kicked over enough stones to find the right one? Or because the way I do think, 1 time's an anomaly, 2 times a pattern, 3 times a trend, right? I pay attention to the patterns and I manage to the trends. And now that trending is these small.
Kels. Hold on, Jay. We just lost audio.
Like you can't hear?
Yeah, but Jay's, it looks like he's muted though.
He's muted.
Oh, he muted?
Oh,
He's playing with you. You
No.
guys are still good here.
Well, yeah, but look, he's talking.
but he's talking. I can't hear him. Oh, looks like the chat room's filling up too. Oh, whew. Jay, I tell you what, brother, I'm so glad that's on your end. I was like, not another one.
You were like, not another one. I was like, not another one.
Let's see.
Are you good to go, Jay?
We can hear you, Rick. All right, Jason, I'll tell you what, since they can't hear you and they can hear us, we're going to give you time to work this out and we're just going to roll with it. I do want, but let's answer a few. Do you want to answer a few?
So you've done the right thing by making sure the bank does the type of loans that you want. So, you know, the real thing is unfortunately, you just got to kind of keep knocking on the door. You get with them, you talk with them. You know, the other thing I would strongly recommend is once you start your own entrepreneurship, move your bank account from the Chase, the Wells Fargo's, the Bank of America. Over there, even if you have $1 million or millions, you're a drop in the bucket at best. When you go to a local bank, they're 1/10 of the size. So your drop is now 10 drops. You're a teaspoon in their bucket. Also, you know, they love deposits. They're community banks for a reason. They want to help people in the community. They want you to create your business bank account with them. And then they want the tenant to send their rent deposits into their bank because it's all going to benefit. You know, another thing is when you move your business bank account over there, they're going to get to see your deposits. So they're going to have, I mean, you're not going to be able to go in there and say, I make $600,000. And then they look at your bank statements and it shows $35,000 in deposits. You know, they're going to know about what to expect from your financials before they even get to see them because they'll have your deposits over the last 6 months, 12 months.
Gotcha.
So, yeah.
Can you guys hear me now?
Yes, sir, we can.
Sure.
Awesome.
It's and the thing I'd like to add on that is, you know, Jay, how many times have you run across someone who wants their, you know, circumstances to change, but they don't want to change? You know, a lot of times, and you know, forgive me for saying this, but you're calling someone who's answering the phone that, you know, would rather complain than meet you for coffee and say, is there something there? You know,
Yeah.
maybe I should explore this a little bit. Guy's got how many properties? Let me look him up on Facebook real quick. He has a group. Oh, let's have this conversation.
Yeah.
And what Rick said, look, if you take away nothing but just this and go back to G.I. Joe, right? Take the action. It's opening accounts with local community banks. Jay, Bank Corp South right now is really investor friendly. Bank Corp South. I use Central Bank here in Houston. Central Bank, believe it or not, only has 4 branches. They are the oldest privately owned bank here in Houston. I picked them on purpose because I want private banks that don't have a likelihood of selling. See, I noticed when I was a kid, my grandfather, I don't know if I told you this story. As a kid, my grandfather, I'd always go to the bank with him and he'd take these double yolked eggs and he'd give them to the bank tellers. And I always thought it was the coolest thing because when he walked in, like everybody was like, Mr. Burroughs.
Grandpa was smarter.
He gave these double yolked eggs. And I'm like, why do you do this? And he's like, well, you always want the bank. He was an investor. He was a private lender. So he got it. Now, what I saw happen is the local bank got bought out by WAMU, Washington Mutual. And if those of you don't know who Washington Mutual is, well, that's because they got bought out too. So I noticed that connection. The person, when my grandfather took in those eggs, they said, Mr. Burroughs, we're very sorry, but we have a new boss. We have new underwriters and new guidelines. So that relationship, although they'd still answer his phone call and talk to him, those perks weren't as there anymore because it was a different bank. So the other thing on top of that is try to look for banks that aren't likely to be sold. Lone Star Bank, it's another good investor-friendly bank. But maybe what we do instead, Rick, of rattling off all the banks is Jay, give us, we'll send you a few banks and then feel free to share them as you like.
Okay.
But commercial
I
loans.
appreciate that. Yeah. I think, and the bank that I use, I've been banking there for 15 years. They're a pretty big regional bank and they just got bought out again. So I can't wait for this whole thing to happen. But what I'm taking away from this is I was looking for a quick phone call to get something done. And basically you're saying, hey, you got to build some relationships here. You got to be able to get dirty for a little bit because I mean, everything's kind of intertwined with this bank I've been using for 15 years. And I look at that, I was like, I do not want to make that transition. But what I'm taking away from you is that is a short-term look, right? And not a long-term solution, what I've got right now. So,
Yeah, and right now, the people who are administering the PPP loans are the commercial, basically underwriters slash the
Right.
commercial guy at the bank. So they are,
How much are they
overwhelmed.
making alone?
Alone? I don't know. They get salary, so.
The banks are making 5%, upwards of 5% on these PPP loans.
Oh yes, those.
So I mean, you're sitting here going, I mean, look, you're people watching this, you're an entrepreneur, you've got a business hat on. If I can make 5 here and 1 here, where am I going to spend my time? So as it turns out, we're just caught in the wheel. Now, if you have the relationship before you need it, and that's the key here, Jay, is we need to get the relationship before you need it. Because now when you're calling, you're flexing your muscle. Okay, I've got my money here. I don't agree with giving them the money before you find out the loan terms. But once you have money there, you tell me, no, I'm moving my money. And you're right, it is a little pain. And we have quite a bit of loans in our servicing pipeline. We have all of our banks intertwined and all of our automatic stuff. Central bank knows, we'll pull the plug very quickly. And that's a whole other topic, right? As investors, as entrepreneurs, we have to be quick at making the decisions we make and then be okay with them and not make them out of, inconvenience.
Yeah.
Which brings
us and that's what I'm doing right now. So I appreciate you guys calling me out on that. There are a couple of questions in the chat about, do you guys have banks that you confer for different states, or do the banks typically lend across state lines, right? These local centralized, not centralized, but local banks, do they?
The community banks will lend in their footprint. So the best way is like Paul said early on, community bank, zip code, and then that's going to be your best bet, because they want their community banks for a reason. They want the people in the community to be banking with them. And so that's basically the best way to go about finding your bank.
Okay.
Echo.
Awesome.
All right, get into number 4. So first again was conventional. Second was non-conventional or non-QM lending. Third was commercial loans, local banks. And fourth is private and hard money.
Yes, indeed.
We love this.
Oh yeah.
This is, I explained private money lending to a buddy of mine who does this, hedge fund investing stuff. He's the guy that goes in, buys a company, then crushes everybody and then sells it for a profit. And he only sold it because he just, got rid of,
cut all the expenses.
Yeah. People, job crushers, what I call them. So I explained private lending to him from the private lender standpoint. And he goes, man, that sounds like Nirvana. So yeah, it is. This is my invitation to you as an investor to look into being a private lender. And the jump to that is not as difficult as you may think. Rewind this presentation, 20 minutes. And I mentioned, please, mom, please, aunt, please, mom, please, aunt. It's Rick mentioned 27 minutes ago. Look in your inner circle. Guys, it's right all in front of us. We get calls all the time. Hey, we have this awesome CRM. You should use it. We have this awesome lead system. You should buy leads from us. CRM, the only CRM you need is an Excel sheet. Just an Excel sheet. If you're not going to do it, any system that you have is going to send out the same stuff that we're all paying for, so it gets lost in email. My 2 cents. And then the other as far as leads, you don't need to buy leads, just like you've got them in your book right now, in your desk right now. You've got all the context that you need to make it happen. So private lending and hard money lending. First of all, what the heck is the difference?
Hard money lending is typically going to be a little bit more institutionalized. They're going to have a money source that is going to require to have input in what they do.
So like hedge funds and big Wall Street, those guys that get us in trouble every now and then, and they're just moving money over and just coming into our neighborhood and trying to take over small businesses. It's like Wall Street money.
Yeah, they'll have lines of credit and Wall Street money.
Perfect. Like Starbucks trying to come in on the local coffee shop.
Exactly.
We can keep going on and on. No. Talks about private lending. What's that?
So private lending is basically going to be underwritten with the people you're talking to. So they're going to have a loan committee that they're going to report to.
Main Street.
And Main Street, Wall Street to Main Street.
Wall Street, Main Street. You weren't ready for that one, were you?
No.
Yeah, so hard money, think of the evil empire, and private lenders, think of Luke Skywalker's and us common folks there. The other big thing is the red tape, right? In all seriousness, with private lenders, or hard money lenders, they're going out, they're borrowing money from hedge funds, from institutional money, like Rick said, from bank lines of credit, and they're giving you a loan on top of those terms based on the requirements of someone else. A private lender is someone who's eaten on the left side of the menu most of their life, saved instead of going on the right side of the menu. And now they've got some money sitting in their piggy bank and they want to lend it out on a secure asset, something that'll give them returns. And that if they don't, well, they can foreclose as opposed to being, a GameStop casualty.
Exactly.
There we are.
Exactly.
Love private lending. Now, this is private lending as an option for you guys is, private lending. Where we go? There we go. All right, private lending, expect double-digit interest rates. This is a Band-Aid loan. You want to get into this quick and get out of it quick. This is used for burst strategies. Buy the property, renovate the property, rent the property, refinance it, and then repeat it. This is used when you don't want to use all of your money, or you don't have all the money to buy it, or the property needs a lot of repairs. This is when you're taking on this financing. Moving on, DTI, debt to income ratio comes into account. What are your debts? How much money you make? What's the ratio there? We want that low. All right, so 4 ways to get around this. In the top left there, top left of ours, I guess it'd be the top left of theirs too. That's how it works. Making it a little hard to, that's a couple that's in love. Look, if you're married and you don't have the W-2 anymore, but your spouse does, first place to go is how can I maximize my spouse's financing, right? Everything in our house is in my name as far as the financing goes on it, but my wife's name is on everything. So that means that she controls the debts and I'm liable, or she controls the assets. I'm liable for the debts. Yeah. It's pretty smart. So just to give that back, my wife owns everything that I own, except that I'm the one that's on the hook for the payments on there. Pretty good place to be. So always look at spouse. Next there at the top, I was trying to find a picture of me when I went to my mom and aunt. I couldn't find one where it looked that bad. So what is this? This is son going to mom and dad and saying, Mom, Dad, please, please, I've got this dream. I've got this vision. Like help me. You ever borrowed money from your parents?
Yeah.
Yeah. Did you pay it back?
Better pay them back. I want to be able to borrow again.
Well, she came into the office, so I know you paid it back.
Fast pay makes fast friends.
You want to pay back, but look, go to parents. That group of handsome, diverse group of people there at the bottom. A lot of you have kids, and you've done a great job raising them. They've got fancy jobs now. They get to wear suits, and they have good credit.
Yeah.
My mom, she's retired. We're looking for a house for her. Guess who she's going to make foot that bill? I mean, it's going on my credit. It's going on my income. Mama's retired. I've got the good income here, so I've got to step in, right? So look, my mom took laundry, dropped me off at school, fed me, spanked me. Did you get spanked as a kid?
Oh, yeah.
So we're that age, we got spanked.
No,
Jay,
no
did you get
kids
spanked
anymore.
as a kid?
Almost daily.
See?
Yeah.
Telling
I
you.
turned out okay.
Yeah. I'm constantly looking at these parenting tips, right? Like, how the heck can I do this? How the heck? And it always says, don't spank your kid, don't spank your kid, don't spank your kid. I don't know, man. Every now and then, you just want to give them a good pop, a nice soft one on the diaper, just let them know you mean business.
That was the only thing that could control me when I was a kid.
Yeah.
It was the fear of the spanking.
And Papa's belt, or mom would come with you. It's a whole different one.
So where that turned from, I spank our kids. My wife does not. But where that turned a corner for me when I was younger is I laughed at my mom when she hit me with her hand. And then she goes, "Oh, wait till your dad gets home and he gets his belt." And that was the worst. That was the worst. That put me in motion but laughing in her face was something that was not, anyway. I know she had to laugh at it afterwards, but hey, we got a couple of questions that came in that with conventional financing, right? And when banks and lending institutions do a credit pull for you, that is going to show up on your score, right? And over time, that kind of pushes your credit score down. Are there any tips to stop that from happening or get your credit repaired so those come off of it? Because that seems like a pretty popular topic here in the chat.
You want me to tackle this or you want to jump on?
I can do it.
Go for it.
So a credit pool is only going to be about 3 to 5 points on your credit score. And when a more registered mortgage company pulls like ours, you get a shopping period, a grace period to shop other registered mortgage companies without penalizing your score. Now, a lot of people will tell me, oh, Bank X pulled my score as a 710. And then I went and 3 weeks later, Bank Y pulled my credit score and I was a 680. And it's because they kept pulling my credit. Well, no, there's no uniform reporting date. So what probably happened is you have a credit card that you use regularly and the balance was a little bit higher. So now you just got dinged for having your higher credit usage. And so the only things that happened were the credit pulls, but in reality, like 4 other accounts reported and they all shifted your score one way or the other.
Did that make sense, Jay?
Yep. Did John, Timothy, you guys both asked that question. So let us know in the chat if you need further clarification on that as well.
And on the thing, on the credit, Jay, the conference of the bankers that you mentioned earlier, those 3 bankers that went to, we have conferences that we go to every year. And at that conference, they tell us, make sure you're pulling people's credit, make sure they're qualified, make sure this. Look, someone calls, it's questions are free. You call in, you say, hey, what are your loan terms? Well, very next question on my mouth is, what's your credit score? Is this for a home you live in, or is this an investment property? And the third question, is this a refinance or a purchase? So I need to figure out, what it is you're doing, and then can give the rates there. And it's an interview process, right? You're interviewing me right now to see if I'm worthy enough to get your credit, your social, to pull your credit. We side with the client we go after. We would be annoyed if within the first 5 minutes you're asking to pull my credit. Like, wait a minute, I'm qualified. Like, I need to figure out if you're qualified to work with me. And I need you to answer a few questions. My wife and I are looking at schools for our kids right now, right? Daughters are turning 3 in March. We like to get them in school next year. So we're calling all the little schools around. And we're blown up with this one school. My wife, I walk in and she's on the phone like, I'm just trying to ask, it feels like I'm pulling teeth here. I'm just trying to ask you questions. And I feel like our clients are that way sometimes. It's like, just answer the question. Do I have to give you the social there? So this is what it is, Jay. Hi, my name's Jay. I have a 780 credit score. I want to refinance.
No, go up a little bit. Don't screw me out of 20 points now.
I've got a 9,000 credit score.
Off the chart.
And then you go through the deal, right? I'm refinancing. I owe 250 and it's worth 300 or whatever the case is. And we all know it, right? Within those first 3 to 30 seconds. And if your gut's telling you that you're talking to a schlep on the other end, just hang up and call somebody else. I mean, just the time that you're wasting, right, Jay? It's not working. Click. Because what's going to happen when you get to properties 4, 5, 6, 7, 8, your buddy, you've got to work with someone that knows how to turn this. And if they're on the phone, how are they going to deal when they're talking to their internal team? Like, you can't talk to me. You're going to talk to your underwriter?
Yeah.
I can't deal with you.
You got to sell the loan. You're going to be a loan committee.
This guy told me,
this loan, guys, but I told him I present it.
So
this guy told me for the way we wrapped up, he said, man, I'm really busy. I expect it's going to be like this for another 4 to 6 weeks. Call me back in about a month. And I sat there and I was like, now, why wouldn't you just make a note and you call me back? Like, why am I like, I feel like I'm the customer and you're doing nothing to say you want to go on a date with me right now. So let's just, we're done.
Exactly.
So anyway,
I
love the analogy. I mean, it's a long-term relationship, right? And it's something that I need to start doing now. So thank you for that.
Where I am in my head right now, it's the person at the gym that's complaining but not going to the gym. Come on.
Yeah.
The 4 to 6 week guy. Forget it. You don't have time for them. Winners need to work with winners. Good people, we need to find each other and we need to stick together. That's a big philosophy we have. So after you've gone to your kids, and before we jump over to friends as the fourth option to look at here, DTI hacks, is with your kids, there's something called a kiddie condo loan. If your kids are in college, you can buy them a fourplex right now with your income, your credit, putting 3.5% down. It's an FHA loan. So it's called a kiddie condo loan, to where you can buy the fourplex with 3.5% down, get owner occupied terms. Your kids live in one unit, they rent out the other units. I have 3 kids. Those three little rascals are all getting a fourplex the minute they can. Are you kidding me? It's going to be, and I'm keeping it, all the rental income from it.
Yeah.
Spending it all. And I hope it's all gone when I die. It's gone. And then last,
I have a feeling
They get the assets.
your thought process is going to change when they get a little older. I did not know about the kitty condo loan. Thank you for introducing me to that.
It's great. And we can also, and Jay also, we can also do it for our parents, right? I don't know
Yes.
the exacts around it, but when our parents get a certain age, we can buy a house for them with owner occupied terms as well. If anybody has questions on those, reach out and we'd be more than happy to ask or get them. And the last, or not the last, but the fourth ETI hack is your friends. Like, again, your inner circle. Look, you went to college with people that have the pretty W-2s. Everyone wants to be a real estate investor. It's sexy. Like, I mean, it just is. Like, yeah, you want to invest in this property with me? Here's what it is. And they're in it now, right?
Yeah.
Talk to them about this.
LLC benefits. Create your LLC. You put your properties in, you can put your investment properties that you purchase at the commercial banks in the LLC name. It takes them out of your account for 10, as long as you're not personally guaranteeing every penny of the loan. Also, you get their better tax write-offs. You get more protection from anybody coming after you personally, and it also can simplify things pretty well whenever you're once you're starting to put all your profits over all your properties over there. Then the profit's going to carry over to your personal return as well.
This is a really, really good one, Jay. This is a great one for your buddy that's already got the 10 conventional loans and he's got the 16 non-QM or however many non-QM it is. See, Fannie Mae's guideline states that you can have up to 10 finance properties for investments. So if you have 10 finance properties or you have 26 finance properties and now you want to buy another investment property, Fannie Mae's saying no. But what if I want to buy the house to live in?
You can do that.
I can get Fannie Mae financing with that. So Jay, your buddy who has, let's just say 25 houses, he wants to upgrade and buy a new house, he can get conventional financing on that. Now, a way that he does not have to show all of those non-QM properties is by having them in the name of an entity. And then here's the big part, to where he has the taxes done, either 1120s or 1065s.
Mm-hmm.
And then what Rick was talking about is the income from the business tax returns are now going to go into your personal tax returns, obviously. But your personal tax returns is just going to look at that as a line item number. Not going to ask for the lease agreements, the mortgage statements, the insurance statements. Why? Well, because those loans belong to your business. Those properties belong to your business. It'd be no different than you own an enterprise car rental place and you're trying to get a loan. They're not going to ask for the statements on every single car that you have. And now, if you're someone who just rents out cars to Uber drivers, that's going to go on your personal tax return. So that needs to be seen, right? So hiding it within your entity not only gives you the protections, the ease, and the insurance and all that other stuff, but also gives you the DTI hack, which was the title of this one. All right. So went to commercial and went to non-QM. Jay, how much time do we have?
15, 20 minutes.
I can wrap. No problem. That's plenty.
Okay.
All right. So typical. So the slide before, Rick, is when to non-QM and went to commercial. So Jay, this is really for, the W-2 or convention is really for conventional financing. And we started this presentation with don't just give up on it because you don't have it, right? You always want to go, and then also checking in on where you are right now tells you how far away you are and what you need to do to get conventional financing.
Yeah.
But the interim options 2 and 3 are the best for long-term financing. For short-term financing, just think private hard money every single time. So now what we want to do is, which one is the best one? Should I use non-QM financing or should I use commercial loan financing? Well, the answer is depends.
Yeah, there is no answer.
So what we did is we want to show you the guidelines and then we're going to go through some numbers. So typically with non-QM loan terms, you can expect 75% loan to value. The non-QM is next. Sorry. We got both slides up here. So typical commercial loan terms are 75% loan to value, your interest rate's going to be what, 4.5-ish, 4.75-ish
In the
plus
fours
minus?
for sure right now.
Adjustable rate mortgages. So this is where your rate is fixed for 5 years, and then it adjusts every year after that. 1 arm. So it's fixed for 5 years, and then the rate adjusts. So when we're talking your rates in that 4.5 range, 4.75, 4.25 for 5 years. After that, it adjusts. Now it's a 20-year loan term. So what you're going to notice when we go to the non-QM, loan term's longer.
Yeah.
Right. If I've got a car payment over 72 months or a car payment over 48 months,
72 months cheaper payment, more expensive loan.
Cheaper payment, more expensive loan. I cash flow more, right? I have more money in the bank, but I'm paying for it over long term. Same principle. Your origination, expect to pay 1 to 2%. If you have the relationship, Jay, you get the relationship established. Bonnie's not charging me any origination. Cindy's not charging Rick any origination. So once you have that relationship built up, not only is it easier, but it becomes cheaper. Little to no underwriting costs. Again, they don't want to nickel and dime you. Boom, we're back. No, 0 to no underwriting costs. They don't want to nickel and dime you. So they understand that once you get to the place of, well, you're a client of theirs, we all get upset with junk fees, right? We loathe junk fees. We loathe and hate them so much we don't charge them. Like our whole branding and marketing is on, we don't charge junk fees. We feel other people that have a similar profile to ours don't like junk fees. And that's a great way to attract a great client, is don't nickel and dime them. Local banks get this as well. Limited rate and cost adjustments. Rick, talk to me about limited rate and cost adjustments.
So they're not doing a scoring system like we discussed in conventional. They're basically just have a interest rate that they're charging. And if you're really strong, you'll get a slightly lower rate. And if you're in need of some compensating factors, one of those will be a slightly higher interest rate. They use it to get your loan closed, not necessarily to create equality like they do on the conventional side.
Yeah, so like these commercial underwriting and commercial loan approvals, think of a big round table, right? Like the Knights of Columbus. And everyone is, they're just, does this loan make sense? It's 99% common sense, 1% real estate. To a conventional, it's just checkbox, right? Like plug it in, does it go? It's like a video game. Do I get to go to the next level or not? It's like, you're done. Try again. It's like, okay, I got to enter some more. Did it work? And then it's like the level. And when you close, you win, and then you go play another video game, right?
Exactly.
Jay, what you got?
So Cindy asked a really good question. There's been a couple in there that I'm going to wait to address towards the end, but Cindy asked a really good question on this topic in particular. What's the best way to approach an underwriter or maybe a loan originator about waiving the origination fee? She feels like she has a relation, or definitely has a relationship, but still being charged for that, likely because she hasn't asked. Is there a way to ask to waive those origination fees?
Hey, Bonnie, I love working with you. And as you know, I've got several accounts here with you. Been a client of the banks for a little over 3 years. And I really, really want to stay here. What's happened is I've got a term sheet from Allegiance Bank. And Allegiance Bank, I've spoken with their loan officer over there, and this is what they're offering me. What do you think? And then power pause. Then you don't say anything. The best things to do is sometimes just ask, what do you think? And put it on them.
Yeah.
Cindy, right? Is what you said, Jay? Is her name?
Yes, sir.
Cindy? Yeah. So Cindy, it can be uncomfortable saying, hey, will you discount your fees? I hate when I'm being asked that. I don't like it. I'm going to discount my fees. Well, part of why I don't like that is because I know when the time is to discount it. And we've done one loan. It's not time right now, So if you've gotten to the place to where it's time, your loan officer should approach you with that. At some point, it becomes more of an art than it does a science. And that, hey, it's a lot harder to go find Rick than it is to keep him. Like, why not just keep him? So what do I need to do to keep him? So that's how I would present it. Cindy is in looking. Now, two things are going to happen when you go look. You may very well find that there is better terms out there, not just lower origination, but lower interest rates. You may also find that there's not. And you may also find that, well, I really like where I am right now, right? I joke, well, I don't joke. conversation I have with my wife very often, similar conversation spouses have is, babe, you're spending too much fill in the blank money. Well, I could go get a cheaper wife. No way. No way do I want it. No. So I hope there's a takeaway there, but just say, hey, I've got the term sheet. Oh man, I'm choking myself up. She's watching. This is no good. Oh, it's happens when you run out of water. Any more questions? Cindy, I hope that helped. But get the term sheet and just say, hey, what do you think? Right.
There is a follow-up question to that from Ashar. She says, should I be concerned that my lender will not give me a term sheet?
Yeah.
Mhm.
Yeah, for sure.
Yeah.
Why? Now these non-QM lenders are real funny about it. You know?
Oh yeah, no,
They're just,
they don't want to give you anything till they see everything.
including the appraisal. I have a client that paid for the appraisal. I said, hey, call this company, work with them directly. You're better off working directly with them than coming through us, blah, 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 explain. So she went forward with it and she paid for the appraisal. I said, great, what are your terms? She goes, I don't know. Got on the phone real quick, say, hey, bro, you can't just charge somebody $700 for an appraisal without giving them loan terms. Like, what is that? So they for sure went to the school, probably taught by Grant Cardone. I'm kidding. Not really. Jeez. Right?
I love the no filter approach. Guys, I want to give you a 5-minute warning. We just so you guys can wrap up, and there's some additional questions that are coming in, but we can wrap up in about 5 minutes.
You got it, brother. So here's typical non-QM loan terms. So let me give this back, take a picture of this. Notice the LTV, notice the interest rate, notice the loan terms, notice the cost, right? Now we're switching over to non-QM. It went up. Your rate's higher, and it says a plus there. It's a lot of pluses. Fixed, ARMs, IOs means interest only. You get 30-year loan terms here. Your origination's higher. Your underwriting costs are higher. You have multiple rate adjustments. See how we call it rate and cost here, Jay? When we went over to Fannie Mae conventional loans, we called it cost. Notice here we're calling it rate. Why? Because these adjustments go to your rate. You're doing a cash out, higher rate. You're doing a 2 to 4, higher rate, not higher cost. See, when the higher cost is a one-time I pay at closing. When it's a higher rate, you're paying it over the life of the loan. So non-QM higher cost. Non-QM rate adjustments. Credit scores, loan to values, loan amounts, cash outs, units, interest only, condos, and you have prepayment penalties. So all of these factors adjust your rate when it comes to non-QM. When it comes to conventional, it adjusts your cost. When it comes to local, community, commercial banks, it's just slight adjustment, compensating factors. Rick nailed it. All right, so when to QM and when not to QM. Look, when you're looking at houses in this price range, right? This loan amount range, rather, 180 to 210, you've really got to put on your thinking cap, and we've got to break out an Excel sheet, and we've got to start coming up. But we've done a little of the math for you. So when it's a $200,000 loan, I want you to compare the two. That 5.99, that, by the way, these are all with 700 or higher credit score. So we just took a flat 700 credit score. If your credit score is higher, these rates come down slightly on the non-QM, slightly. But if your credit score, we have 5 minutes. 4.5, 5.99. One's a 20-year term, another's a 30-year term. I want you to look at the cash flow. That's the point of us showing this here. You're going to think the 30-year loan is going to give you a lower payment. It does, but how much lower? A $68 a month lower payment. So are you better off not cash flowing that $68 for the next 60 months? Or are you better off taking a 30-year fixed loan? The answer comes down to how long do you intend on keeping the property? Because if you're going to keep a house for 5 years, definitely commercial. If you're going to keep it 30 years, well, maybe still commercial. Because when the rate adjusts, it might not adjust above a 5.9, right? No. So, but here's the big sauce is look where you owe in 60 months. In one, you owe 186, on another, you owe 165. So if you give up $68 a month for 60 months, that's less than $4,000. You're right at $4,000. You're saving almost $21,000 in interest. When you sell the property and you owe less, you make more, right?
Make more money.
Make more. On a 250 loan amount, guys, is here. Oops. Come back one more. 50,000, 250 loan amount. Look, you're saving 26,000 in interest for a payment that's going to be $84 higher a month. So run the numbers on these to make the best decision. 3 underwriting pitfalls to avoid. Rick, now. Start the loan process now.
Start it now. Find out where you are. Also, before you file your 2020 tax return, talk to somebody. We get to add back non-cash losses. There are tons of add backs. It's a matter of, you don't necessarily have to report a ton of profit, but writing off the right items at the right time will still give you usable income, but a low tax, but a low tax liability.
You also want to get in line quick. Like the worst time to do something is right when it needs to be done. Get started early. Also, don't conceal the truth. Don't hide the truth. Tell your loan officer what's going on. Hey, this is what I have. This is what I want to do. Think of us as your attorneys, not just because of the awesome fancy suits, and you look good, brother. But think of us as your attorneys. Tell us what you need to tell us. We'll present your case to the judge. We can withhold stuff to underwriting, or we can say, hey, judge, here's where it is. Underwriter, here's what it is, and get it going. Also, stop with the excessive losses. Look, you're not going to write off everything and then get upset because you don't get the best loan. The best thing is writing off everything. So if you're writing off everything, you're saving thousands of dollars in taxes. Pay a slightly higher interest rate. Who cares? That's a tax write-off anyway, right? Yeah. So if you're going to play the game and you're going to take all those losses, just know that conventional financing and even commercial financing, if you're going to a bank and saying, I'd like to get a loan, but you lost $80,000 in your business, would you lend to that person? Quick market update. Interest rates are low. How low, Rick?
Investors should be paying between 3 and
we already told them investors.
4%.
Look, we've got 90 seconds to wrap this up. Stop paying high interest. You want to figure out what your interest is? Just send us a copy of your mortgage statement to either Rick or Paul at blinklending.com. Right now, owner-occupied interest rates are in the mid to low 2s. If you want lower costs, you take a slightly higher rate, but we'd love to show you what's available to you, especially if your property's here in Texas. Want to get more information, go to blinklending.com. We hate junk fees. We don't charge them. Why blinklending.com? Well, God created peanut butter. He also created jelly. Separately, they're amazing. You put those bad boys together, you have the PB&J sandwich. It's a beautiful thing. We do peanut butter and jelly loans. We're a private money lender. We are a conventional lender. Jay, you got any questions?
I love it. Yeah, we got a couple of questions coming in. Yeah, no, my timer just went off. Yeah, I mean, you nailed that. You didn't even know I started at 5 minutes either. Let's see. There was a couple here. By the way, can you go ahead and put up your contact information again? I want to make sure people got that. They were asked. That's perfect. There were a few folks. Kevin was asking for that, and Shar was asking, where can she find out more information on the Kitty condo loan?
So Google, or you can always contact us. And your local mortgage company should know about it as well. But call us. We'd love to chat with you about it. Or go on Google, Kitty condo, and then just starts popping up.
Yeah. And Colleen, you had a question very similar to something they just covered, basically dig your well before you're thirsty, right? And so Colleen, if those guys didn't answer, Paul and Rick didn't answer your question. Her question was best recommended advice for lining up lending in advance of identifying to a purchase. You have equity, do score, liquidity. She only has rental income, but can also use a strategic partner. If they didn't answer your question, let me know in the chat. And we'll make sure we get back to you. There was another one up here. Oh, Alex asked, guys, I have 2 refis coming up in a couple of months, approximately 240,000. I don't know if that's a combined or both of them are individually 240,000. Just curious how you would proceed from here. Would love to scale from here. What route would you take as far as financing?
I mean, that's just going to depend on the situation. If he's, I currently have a client who gets $800 a month in retirement and is refinancing an investment property. So, there is no secret number. Oh, if you're only reporting this, you can't do this. So you got to look at everything, and, his situation is it's highly customizable. So his situation is going to determine what the best product is for him.
Okay, so Alex, best place to start. Love it if you gave us a shout. We'd love to walk you through it. Even if it's not a property here in Texas, we can still talk through the logistics of it. So first question I would ask is on that 240. And Jay, if you ever give up on what you're doing, you do have a career as a loan officer, because that is the question. Is it a combined, both together or separately? And if it's both, if it's separate, I would heavily lean towards the commercial side. If it's combined, I would probably still lean to the commercial side. I'm a commercial guy. I want to go there because, if I get a 4.5 or a 4.75, and for the next 5 years pay 1.25% at minimum, that 5.99 rate we put there, that was being generous. We could have, it's 6.75. It gets up there real quick, guys. So when I'm looking at for the next 5 years, I can pay a lower rate. That means more money is going towards principal. And if I sell it, I'm going to make more. But if I keep it, the rate's just adjusting to prime. So I'm in a okay position. As prime goes, it's going to be prime plus 1.5. That's how all banks operate. So it's going to be the same thing then. Now, Alex, that's if conventional financing is not an option, right? If conventional financing is an option, then let's explore that route first. And again, looking at your inner circle and really having, look, I'm not making this up. This is a fly we're working on. It's called your lender cheat sheet. And it's got, here are your 3 options for conventional, FHA, and VA for first-time home buyers, right? And we want to line up. What's the option if I do a strategic partner? What's the option if I do this commercial? What's the option if I do it non-QM? And having that, okay, that's the decision I make here. It's not one size fits all. You have to take the holistic approach. You have to look at each transaction property separately. And here's the biggest thing. What's your exit strategy? Rick and I, we put an offer today on a building down the street. We want to convert our office into it. We're looking at it going, okay, if we're going to be here 5 years, what can we do with it then? If we're going to stay longer, what can we do with it? Can we sell it to an insurance company, a real estate company? What are our exit strategies? And you want to look the same way.
Yep. Very cool. What areas do you guys only lend in Texas, or is it outside of Texas as well? I know you said earlier it's God's country. There may be some people that agree with you. I am not one of them, but I couldn't let that go. So where all do you guys lend?
All over Texas.
Okay.
We've lent, we've gone once outside. It was in Florida for a very good friend of ours. We're more likely to just work in Houston than we are to go outside of Texas. At the same time, if anybody has questions, please call us. We'd love to get you the answers. And for outside of Texas, we're looking in our conservative states, Florida, southern states, Florida, Georgia, ones that have similar Texas laws when it comes to foreclosure, because it's private lenders. When we're doing private, and this is only for private money. Conventional loans, no, we're only licensed in Texas, but we have affiliations to where there's no compensation on our side. Like we work with approval departments that do work in other states. So we have clients all the time. Paul, I have a loan in Florida. Hey, Kevin, do you have anybody in Florida that can give the same rates that we would here in Texas? Okay, awesome. And then we connect you over there. So call us. If you have a lending question, please think Blink.
Very cool. Anything else, guys, in the state and questions, let us know. Just a couple of takeaways that I learned today, and I love Paul. I think you have a repertoire of one-liners Rick, you've just got to be entertained all day. Either that or annoyed. I'm not going to ask you which one it is, but either you're entertained or annoyed when you're around Paul. But very entertaining today. I love the line. You can negotiate with a terrorist, but you cannot negotiate with an underwriter. I feel like underwriters are a mythical figure that loan originators get to blame so they can play the good cop, bad cop scenario. That's always been my story.
I swear it wasn't my mistake. It's the underwriter.
Yeah, it's not me. It's the underwriter. Can I talk to the underwriter? Well, no,
Nope.
You can't.
No.
Oh, no.
So, because he doesn't exist, right? I get look weird when I say that. But, and one thing I do want to encourage people to do is what you started at the very beginning and you sprinkled it out through the entire presentation. When you're looking at private money, start with your friends and family. Right. And one of the best questions that somebody planted in me a long time ago is when you have that question, when you have that conversation with your friends and family and they say no, or they're not able to do, work with you at the moment, the follow-up question would be, well, who do you know that I should be talking to? Right. That may be interested in working together. But I love the fact that you guys combine private money, conventional loans to make things happen. I have not seen a lending because up until this point, I've just done conventional loans, right? Or commercial. I have not participated in where it's a combined. So I think it's very interesting to see, and looking forward to learning more from you guys on what could be next for me here in Florida. I've got one property in Texas, but it's a syndication, and it's not very future. But guys, I want to appreciate you for your time, presentation, all amazing stuff. For everybody watching, or for those of you who actually, if you've already left, you don't even know I'm saying this, but I'm going to email this out, the recording out. It will be available later for replay in case you want to go back and get these guys' contact information, or if there's a point you want to go back and just make sure you understand. Rick, Paul, anything else you guys want to add as we close up?
On two things, the family members, asking them. I love the follow-up question that you said to ask. The important thing, though, is you have to ask them, because when you ask them in 2020, they may not say yes till 2025. Well, 2025, it's right around the corner. But if you wait till 2025 to ask them, it might be 2030 until you get the money. So got to do it now. The other part, before I let Rick say, is don't ever let anybody take your joy away from you. Rick, what you got?
One thing, a lot of people think private money, more cost. Private money is about capital conservation. So it's about coming out of pocket less. That's why it's there, is so you can leverage what you have, like, with someone else's money, and save more of your cash in the bank.
That's what you're going to end with? I thought you were going to tell us to scan this and follow us.
Well, and you can scan and follow as well.
Jay, you're awesome, man.
Thank you, guys. I appreciate this very much. Again, if y'all have any questions for Paul or Rick, you can reach them both at either Paul at Blink Lending or Rick at Blink Lending. It's almost like we just planned that. You guys jumped to that slide. So thank you guys very much. I look forward to chatting with you further. Y'all have a great day.
Thank you. Cheers.